I want to welcome everyone to today's session. Today we're talking about Chapter 8, Accounting for Long-Term Assets. Now, so the cost principle for computing the cost of planned assets. Remember, a planned asset has to be tangible nature. You can touch it. You can physically see it. Okay, and again, it has to be used in the business. Okay, you don't just use it for, like, say, 1 period, 2 periods. No, a lot of times you can use it for many years, such as all your equipment, all your buildings, land, everything. Okay, and another acronym for it, we call it PP&E, property, plant, and equipment. Again, a planned asset, there's 3 things we got to talk about here with it. Get the acquisition, get the cost of it, how long we're going to use it for, and what's the last part, dispose of it. And besides land, nothing lasts forever. Remember, to do the cost determination, first of all, don't just think about the purchase price. Think about everything you need to acquire the asset and prepare it for its use. Again, it's normal and reasonable to get an asset ready for intended use. Such as machinery and equipment. Besides the purchase price, you got to pay taxes, installation, assembly, testing. Insurance only when it's in transit, not afterwards. Transportation charges. And building, you don't just buy a building, you got to pay everything. From brokerage fee, again, taxes, attorney fees, title. Maybe you got to fix it up. If it needs any renovations. And land improvements is what's around the land. Such as, did you fix the sidewalk there? Any fences, shrubs, lighting systems? Remember, land is the only not depreciable asset under property, plant, and equipment. The reason why, it has indefinite life. Land will always be there. But again here, besides the purchase price, you got to pay sometimes to purchase land, from real estate commission, surveying fees, property taxes, and so on. Remember, everything you need to acquire the land and get it ready for use goes into the land's final purchase price. Sometimes what happens when you buy a lump sum of assets. For example, you bought some land in a building. Okay, you account for them separately, but now here's the question comes, how much you go to which? You paid $90,000 for it. Well, you got to do a little estimation here. Get their appraised value. You can start right here. Then what percentage out of the total appraised value is it? For building, 60%. Take 60% of the 54,000. I'm sorry, 60% of the 90,000. Goes 54. And the rest of it, land, take the 40% of the 90,000. Should be 36,000. Again, I can talk about cost principle, value to all necessary costs, get it ready for its intended purpose. So again, cost of any machine, besides the price, any sales tax, take out some discounts, assembly costs, and so on. Now the big question, all these assets besides land, they're going to depreciate. Okay, let's talk about depreciation here. And depreciation is not the decline in value over time, it's when you allocate the cost of the asset over its useful life. So again here, 3 things we got to take into consideration when we do depreciation. Cost, salvage value, and useful life. Okay, straight line, you got 3 methods to depreciation. You got straight line, units of production, and declining balance. Remember, cost we just talked about. Salvage value means at the end of its useful life, how much do you think that asset will be worth? In this case, you bought the asset for $10,000. Okay, the useful life, I plan to keep for about 5 years. At the end of 5 years, I estimate I can only get $1,000. Remember, the salvage value, useful life, all we can do is estimate those. We don't know those exactly. Straight line method, like it says here, take your cost, $10,000 minus $1,000 salvage value, divide by 5 years. So here it doesn't matter. Let's say it's machinery, use it 1 month out of the year, or use it every day. You can depreciate it $1,800 a year. Okay, it doesn't matter how much you use it. And again here, you want debit depreciation expense, and then credit, accumulate depreciation. Remember, depreciation does not affect the original cost of the asset. We leave that alone. And again, how to look on the balance sheet. Here it says, after 2 years. So again, we bought $10,000. I estimate now it's worth $6,400. Maybe more, maybe less. I guess straight like it says here, you would do the same amount of depreciation per year. That doesn't change. Up until, for this case, 5 years. And again, the book that at the end should be its salvage value, which we estimate at $1,000. Units of production, this one bases off how much we use the asset. So now it does take consideration. And do we use it 1 day of the month, or do we use it every day? So here it says, okay, this machinery is going to inspect 36,000 shoes. Again, take cost minus salvage value divided by unit. So each shoe that it inspects, it'll be 25 cents a unit. So the first year we did 7,000 units times 25 cents. As much as our depreciation will be for the first year. Now if you notice here, depreciation fluctuates. Because again, it's based on usage. And we keep going up until we hit 36,000 units. We're not going to go above that. You can use the machinery afterwards, except you can't even with depreciation. And again, if you notice here, the book value will still be $1,000. Again, we keep going and going up until we hit 36,000 units. That's why if you notice, the depreciation expense is different every year. But it's still based on 25 cents a unit. Now, double decline, like it says, whatever your straight line rate was, which is 100% divided by 5 years, we double it. So it'll be 40% a year. These are assets that lose value quickly, such as electronics, like your laptops, cell phones. So here it says, 40%. We start at 10,000. Now, we cannot go below $1,000 for our cost. That's why many times the last year, your depreciation expense, you can't take 40%. If I take depreciation 40% at $1,296, it'll go below $1,000. I can't do that. That's why this last time's a lot of times you got to plug it in. Take the $1,296 minus the book value, $1,000. That'll be depreciation. But if you notice, depreciation keeps going down because it's based on the book value, which is being decreased every year. Okay, the most important thing to remember is it doesn't matter which method you use, you're still going to allocate the same amount of depreciation. The total will be the same. But again, the big difference is how do you get there? Now, straight line, same every year. Units production, how much you're using, double declining. You get most of it in the first few years. Again, if you notice the last 2 years, it's pretty slim. And for tax purposes, again, remember tax purposes, use the modified. Okay, now remember, sometimes you might buy assets in the middle of the year. We don't just buy them for January 1. Again, we can't take depreciation for the entire period, only for partial years. It says, okay, you bought it, it was purchased October 8th. So you can only have 3 months of depreciation. That's it. Can't take it for the full year. Again, divide by how many months you can use it for by the total months in the year, 12. So instead, again, remember, it's 1,100, we only get 450 now. And how about if you change it? You may change the salvage value. Say, oh, this thing now became an antique, a collectible, or useful life. I thought I was going to get 5 years, now I can do 10 years. For example, let's look at what it was. So now, you change the salvage value. So we started, what was the book value at the time we changed the salvage value? Well, at the time we changed this estimate. Okay, take the current book value, minus the new salvage value. Divide by how many useful life, the remaining years we have. So now it'll be $1,500 per year. Okay, so again, we start at point depreciation. Example 1. Yeah, if you notice, again, the total is going to be the same for all of them. In a straight line, same every year. Doesn't matter how much you use the asset. Units of production, that does matter. $20 per unit. Again, we keep going up until we use up all the units. And last one, double decline balance. Remember, double the rate. So 20%, be 40%. Again, this one again, you get most of the depreciation in the first few years. Remember, you can't go below the book value. Again, if you want to revise again, start with the straight line minus original. Then use the revised one. Again, let's talk about what's a revenue expenditure and a capital expenditure. A revenue expenditure is a normal routine expense, such as maybe you have a building, change the light bulb, fix a small little crack. A capital expenditure is a major renovation. I put a new roof on the building. I renovated the entire floor. Again, revenue talk about it's a routine, ongoing expense. Maybe a car, change the oil. A capital is major overhaul. I put a new engine in there. May extend the useful life. Now, what happens when we want to dispose of an asset? Any reason. You may want to get rid of it. You may want to sell it. You got to follow the steps here. First of all, update depreciation when you sold it. Did you sell it maybe in October? Journalize if you received any cash. Now, remove all accumulated depreciation. Remove the asset cost. Again, see, did you have a gain or a loss when you sold it? Compare how much cash you received, how much was worth at the time. It's book value. If you receive any cash, again, if it's above the book value, you got a gain. If it's below book value, it's a loss. If it breaks even, you don't make any entry there. So you want to discard something. This one's straightforward. It's okay, discarded, June 5th. You fully depreciated, no salvage value. So again, all we got to do is debit accumulated depreciation. This removes all accumulated depreciation and credit machinery. All they did was delete from our books. Now this one says you got rid of it July 1. Well, first of all, you got to take partial depreciation for half the year. Update the depreciation. What is the current depreciation? Now, remove all the accumulated depreciation. You didn't get any cash for it. You just lost there. So we got rid of it as worth $8,000. Except you'll only depreciate $6,500 of it. So you lost the difference, which is $1,500. Now say when you sold assets. Again, update depreciation at March 31 for 3 months. How much cash did you get for it? $3,000. Accumulated depreciation was $13,000. Since it worth $16,000, you see right here, you broke even. No gain, no loss. Now say it's above book value. Okay, so you see right here, take the difference here. How much cash you got? Accumulated depreciation is $20,000. It was worth $16,000. So overall, you gained $4,000 there. That was below book value. Well, now remember, it's going to be a debit there. You lost $500 there. It was worth $16,000. You only recovered $15,500 of it. Give some examples here. Betterments, improvements, repairs. Again, it's a purchase. See when you purchase it. About equipment, cash. Again, if you notice right here, it goes to the original account balance because it's for a new component. Increase its life by 20% a year. Next part, a routine expense at just $250. Again, to increase useful life, again, that goes to equipment and cash. The original asset account. Again, look at different things here. When you first buy the machinery, get the depreciation up to date. Look at that as $100. Get the cost. It's loss here, where the cash is smaller than book value. Cash is greater than book value, it goes to be credit. Let's do different examples here. $100, you get rid of the depreciation, and you lost here. You just got rid of it. So you lost $100 there. Now it says you sold it for $80. Again, I'll remove the depreciation and the asset cost. See how much cash you got. And you lost again here. Lost $20 there. Now, how if you got $100 for it? Again, machine accumulated depreciation, that doesn't change. Cash, you got $100 there. But the good part is now, well, the last one, you got a gain here. That's the good part there. Okay, so natural resources. Our natural resource example is oil, gold. We're going to follow the same logic, but it's not going to be depreciation, it's going to be depletion. Because once you get it out of the ground, let's say oil, gold, it's done. There's no salvage value here. Once it's gone, it's gone. Let's take an example here. You estimate 250,000 tons of ore when you buy this mine. Again, you know salvage value is 0 because once you take the ore out of the mine, it's gone. It's done. Again, it says 500,000 divided by 2. So each ton of ore that comes out of that mine, we're going to deplete it by $2. So again here, and now it says saying depreciation, expense, accumulated depreciation, we're going to put a depletion, because once it's gone. So for the first year. Again, we bought $500,000, now it's $170,000. Now that mine is worth, we estimate about $330,000. Again, the plant assets, like say the equipment you need and everything, those will be accounted for separately. Yeah, the zinc mine. How much ore you took out? We see it's $4 per ton. Took out 50,000 tons the first year. Again, that'd be depletion expense and the zinc inventory. All right, the last part we talk about is our intangible assets. Intangibles is, they lack physical substance. They can't see it or touch it. Again, these are for your copyrights, your patents, franchises, things of that nature. These aren't going to depreciate or deplete. They're going to amortize. Copyright. Copyright's not forever. Life of the owner plus 70 years. Again, the same thing here. In this case, copyrights in this case was 5 years. They're different. So we're going to amortize them and accumulate amortization. These whole improvements. Again, here you bought a patent, and you amortize the patent over its useful life. Okay. All right, class. Let me know if anyone has any questions, all right? Thank you.